Stock 101. What are the different stock investing types? Historically, stock market investing has been a key to financial success. When studying stocks, you'll frequently hear them mentioned in terms of categories and classes. Here are the primary stock kinds to know. Ordinary favored stocks, large, mid, and small. U.S. stock, global stocks, IPOs, goodbyes, IPOST, div stocks, non-dividend stocks, yen stocks, cyclical stocks, non-cycle stock, treasuries, ESG at Nasdaq stocks, coin stocks, common and preference. Most stock investments are in common stock. Shareholders of common stock are entitled to a proportionate share of the surviving assets if the business is dissolved. Shareholders have infinite upside potential, but they also risk losing everything if the firm collapses with no assets. Preferred stock operates differently, giving investors a preference over ordinary stockholders in the event of a company's dissolution. Preferred shares also get dividends before regular stockholders. As a consequence, preferred stock frequently resembles fixed income bond investments more than ordinary stock. A firm may only provide common stock. That's what most stockholders want, after all. Stocks of various sizes. Stocks are also classified by their market capitalization, or the sum of all their shares. Large cap stocks are the most valuable, followed by mid cap and small cap stocks. These categories aren't well defined. Stocks with market capitalizations of $10 billion or more are considered large caps, while those with market capitalizations of $2 billion to $10 billion are considered mid caps, and those with market capitalizations below $2 billion are considered small caps. However, tiny and mid cap companies offer higher potential for future development but are riskier investments. But just because two firms are in the same category doesn't indicate they'll perform similarly in the future. Make your portfolio represent your future vision. Stocks at home and abroad. Stocks may be classified by location. Most investors look to the company's official headquarters to determine which stocks are domestic and which are foreign. It's vital to note that a stock's geographical categorization does not always reflect the company's revenues. For example, Philip Morris International, NYSE, PM, has its headquarters in the US, but only sells tobacco and other goods abroad. It's difficult to discern from business operations and financial data if a firm is genuinely local or global. Value and growth stocks. Another technique categorizes two major investing strategies. Growth firms are those whose sales and earnings are rapidly increasing. They seek firms whose stock is cheap compared to its peers or its own historical pricing. Growth companies are riskier, but the potential profits may be huge. Businesses that tap into strong and increasing consumer demand, particularly in relation with longer-term developments in society, are successful growth stocks. But if competitors disturb a growth stock's operation, it may swiftly lose popularity. Investors fearing a reduction in long-term economic potential may cause prices to fall substantially. Value stocks, on the other hand, are considered safer. They're frequently established, well-known enterprises that have become market leaders and so have less space to develop. With proven business methods, they might be ideal selections for investors wanting greater price stability while still gaining exposure to equities. IPO stocks are equities of newly public corporations. Investors eager to join in on a new company idea are typically enthralled by IPOs. But they may be volatile, particularly when the financial community disagrees on their growth and profit potential. A stock remains an IPO stock for at least a year and up to 2 years after it goes public. Dividends and non-dividends. Many stocks regularly pay dividends to owners. Dividends offer vital income for investors, making dividend stocks desirable in certain circles. A corporation that pays even 1 cent per share qualifies as a dividend stock. No need to pay dividends on stocks. Non-dividend stocks might still be good buys if their prices climb. Some of the world's largest corporations don't pay dividends, however this has been changing in recent years. Yen stocks. Most equities give out income in the form of dividends, Hence, income stocks are also known as dividend stocks. However, income stocks are shares of corporations with more established business structures and less long-term development potential. Income stocks are popular among retirees who require immediate access to their funds. Stocks cyclical and non-cyclical. National economies go through cycles of growth and decline, including booms and busts. Investors call cyclical stocks companies that are more susceptible to large business cycles. Cyclical equities include corporations in areas like manufacturing, tourism, and luxury products, where clients may be unable to make large purchases rapidly. When economies are robust, demand surges, causing these enterprises to recoup. Non-cyclical equities, often known as defensive or secular companies, don't have such significant demand fluctuations. People need to eat, regardless of the state of the economy. Non-cyclical companies frequently outperform cyclical stocks during market downturns, but vice versa. Safe stocks have very minor price fluctuations compared to the total stock market. Safe stocks, often known as low volatility equities, generally operate in sectors less vulnerable to economic situations. They frequently offer dividends, which may help offset dropping stock prices. Investing sectors. Stocks are often categorized by industry. The most common categories are telephone, internet, media, and leisure services. Retailers, automakers, hotel and restaurant chains, etc. Consumer staples, food, beverage, tobacco, and personal care items. Energy, oil and gas producers, pipeline operators, and gas station owners. Banks, mortgage lenders, insurance and brokerage firms. Health insurers, pharmaceuticals and biotech businesses, and medical device manufacturers. Companies in the industrial sector include airlines and railroads. Companies in mining, forestry, construction, packaging, and chemistry. Real estate, rights and property management and development firms. Hardware, software, semiconductor, telecommunication, and IT services. Utilities, electric, natural gas, water, and renewable energy. Investing in ESG. Environmental, social, and governance, ESG, issues are addressed in ESG investing. Rather of concentrating just on profits and sales growth, ESG principles examine collateral implications on the environment, workers, consumers, and shareholder rights. Socially responsible investment, SRI, is linked to ESG's guidelines. SRI investors select out stocks that don't align with their core principles. Rather than just rejecting firms that fail key standards, ESG investment actively promotes investing in the companies that do things best. There's a lot of interest in ESG investing since it seems to boost investment results. Stocks of various sizes. Finally, there are stock categories that judge quality. A blue chip stock is one that belongs to a company that leads its industry and has a good reputation. They don't always yield the biggest profits, but their steadiness attracts investors who are less risk tolerant. Penny stocks, on the other hand, are low-quality enterprises with stock values under $1. Penny stocks' risky business methods make them susceptible to scams that drain your whole investment. It's vital to understand penny stock risks. You've undoubtedly heard that portfolio diversity is critical to long-term success. Investment across firms, locations, and investing styles leads to a well-balanced portfolio. Don't just buy Bitcoin, earn it with blockfi. When you spend with blockfi, you can earn up to 3.5% back,